Thank you very much for that. Good afternoon to everybody. My name is Katy Thorneycroft and I'm a multi-asset portfolio manager at JPMorgan. I'm going to talk to you about multi-asset investing more broadly, but also about our new multi-asset trust, which we've just launched at the beginning of March. Can I also point out, hopefully you like the pun in the title, trust in a multi-asset approach in late cycle and beyond. So there you go, that's my gag for the presentation. So we think we've launched this trust at a very interesting time. In 2017, we had pretty spectacular equity market returns with really quite modest volatility. And while we've had positive returns year to date in 2018, it's been something of a more exciting ride, I think it's fair to say. Now, from our perspective, rest assured, we think we've reached normal levels of volatility in markets. We think it's quite normal for this time in the business cycle. So it's nothing to be concerned about, but it hasn't been as smooth year to date so far. We also think that as we're looking forward, we've had a lot of supportive behaviour from central banks over the last few years, and we've got past that maximum point of accommodation. And when you think about monetary policy around the world, this is going to be one of the drivers of increased volatility, in our opinion here. The other aspect is business cycles. If we look around the world, they are, of course, all at different stages, but in some markets, and I'll show you this in a moment for the US, and I think it's also true in the UK, we're starting to approach the end of the cycle. We would say that we're in late cycle in some parts of the world. So if you combine central banks being a little less supportive, less of a tailwind, and you think about where we are in business cycles, we think it's going to be a little bit more volatile. So from our perspective, when we think about multi-asset investing, we want to, this year we really wanted to introduce a new trust to the multi-asset range that we have within our team, but importantly to the JPMorgan Investment Trust stable as well, and we think it's a good time to start to think about multi-asset investing. Now, when we think about the business cycle, I've commented on that already, but we are in a business cycle which is the second longest on record since the end of World War II. And that really is quite something. So that length of that business cycle is unusual, and I'm sure you've been reading about that in the press. So in terms of our multi-asset team, we spend quite a lot of time thinking about some of these aspects. Now, I know that Dan said earlier you don't want to be forecasting GDP growth. We would agree, we do a lot more than that, but it is important to understand the overall backdrop in terms of supporting equity market returns. We're a team of 80 investment professionals. We've got a 45-year plus track record. I should clarify that's my track record. And we're really leveraging the strength of our overall JPMorgan Asset Management investment platform as well, meaning that we're investing in some of our underlying managers there. So this new baby in the JPMorgan Investment Trust stable, the multi-asset trust, we're looking for capital growth and income through time. So you can see the 6% expected returns through time. We're not expecting that every given year, but over the long term, we're hoping to be able to achieve that. And we think that's quite attractive, especially if you're in retirement. We're also hoping to deliver around 4% of that from a yield. And I'll show you the reason why we think that's important in a moment. And we're going to pay that on a quarterly basis. So if you want something coming into your bank account on a quarterly basis, then we think this is an attractive vehicle to be looking at. Because we're multi-asset, you're not going to have all of the same volatility of equity markets here. And through time, we'd anticipate that the overall risk within this portfolio will be around 2/3 of that of equity markets. So this is the new JPMorgan Multi-Asset Trust. I'm going to forewarn you, its ticker is MATE. So when you're searching for it, and when you hear me say MATE, that is what I'm referring to there. Not the best one, perhaps, but probably quite easy to remember. So what I'm showing you here is trying to explain where we've come from and where we think we might go to. So first of all, on the left-hand side, we're showing a simple, balanced portfolio here. So we're looking at global equities and global government bonds. So on the left-hand side, over the last 18 years, so this is since the peak of the tech boom, a simple balanced portfolio would have delivered you just over 6% per annum, which is actually a pretty decent return, even though you've been through two pretty big bear markets over that period of time. If you look in these middle periods, you can see post the financial crisis, over the last 5 years, over the last 3 years, returns have been more like 8 to 9%. And again, this is just from a balanced portfolio, so quite simple, quite straightforward. So you've had pretty decent returns from quite a modestly positioned portfolio here. But when we're looking forward, we think that perhaps asset market returns alone are not going to deliver you the same level of returns. Every year, we assess on a forward-looking 10 to 15-year basis the returns and the risk we might expect across asset classes, across markets. If we would look at this over the next 10 to 15 years, we would anticipate perhaps you might get a more modest return from a balanced portfolio, from a 50% equity, 50% bond portfolio of maybe 4% per annum. So still positive, still worth having, but it doesn't get you to quite the same level looking forward as it has done in the past. And I think the message here, when you relate it back to MATE, our multi-asset trust, is I think you need a broader opportunity set looking forward. And that, for us, having a broader opportunity set of asset classes in which to invest will allow us, hopefully, to be able to stretch for a little bit more of a return, but also help mitigate volatility through those benefits of diversification that we can get. I realise that for those sitting at the back, you might not be able to see all of these categories, but I wanted to show you this because I wanted to look at a shorter time horizon. So I've talked about how we think you're going to get likely lower returns over long periods of time looking forward. But let's have a think about the current time horizon. And we can relate it back to that cycle that Dan was showing us earlier. And I've said that I think we're probably in late cycle at the moment. So how do we assess that? So as a multi-asset team, we think about the business cycle in a couple of different ways. We think about a lot of economic metrics, and we also think a lot about asset market metrics. It's very much a grey exercise. It's not black and white. It's very difficult to pinpoint exactly where you are. We take what we describe as a scorecard approach. I can't tell you that if we have 6 of these grey boxes on the right-hand side, then we're starting to worry, or 10, or whatever the number is. It is very much, we need to assess all of this information and make a judgment on this. I've shown the scorecard here for the US. We think its business cycle typically has most influence on global equities and global government bonds around the world. And we've seen already that the US business cycle has been going on for 9 years. So when you put that into context, the previous longest cycle was about 10 years, from 1991 to 2001. So we're at the second longest cycle since World War II already. When we look at these different metrics, and we've got the economic ones in blue at the top, we've got the asset market ones in purple at the bottom, our judgment is we are in late cycle at the moment. And I'm going to highlight a few here. So if we look at unemployment as an example, we think at the moment that unemployment in the US is broadly around the natural rate of unemployment. Now, you may have heard talk of Nehru. It's notoriously difficult to estimate what this natural rate of unemployment is. You don't really know what it's been until you've been through it. However, we think we're getting close, and we think it's an indication of a lack of slack in the economy. So that's one quite important metric. We look at something like private credit formation. So this, we think, is rising faster than the overall growth in the economy. Again, so people are borrowing a little bit more quickly, which often accelerates the end of a cycle. If we think about overall GDP growth, I would agree you don't care particularly about the absolute level, but you do care where you are versus overall trend rates. So if we look in the US, for instance, we think that growth is above trend and still rising. So again, that's a phenomenon you usually get in late cycle. And then just thinking about some of the asset markets. Asset market investors, typically you might be looking through some of these economic metrics. If you look at credit as an example, down to credit spreads here, so you're thinking about corporate bonds and what are you getting in terms of your yields versus government bonds here. We think we're past the minimum in terms of spreads for this cycle, so they're starting to widen already. You can also think about corporate margins. We think we're past the peak in terms of corporate margins. So we're still expecting to see earnings growth, but probably likely past the peak. So I'm showing the US here. We think the US is in late cycle. We'd make very similar observations about the UK economy as well. So I haven't included the chart here. We would look at very similar metrics. We'd probably also include the housing market, where housing prices are relatively high on average. So we'd also say that the UK is in late cycle. So it's very easy to hear that and then think that the end is nigh. But we're really not saying that. We don't believe that that is the case. It's okay to be in late cycle, and you can still expect positive returns from equity markets. On average, for a start, late cycle usually lasts about 2 years, and we've already said, this is not an average cycle. What I'm trying to show here in terms of market returns is US equity market returns before and after the market peak, plus then the returns in the bear market. So the bear market is that purple bar, the big negative one on the right-hand side, and the green bar is the prior 12 months up to the market peak. The grey bar is the returns you get 3 months after the market peak, and then you've got the blue bar, which is 6 months afterwards. So one message from this is that in those 12 months up to the market peak, you could have anywhere between 10% and 30% returns. Those are attractive returns. You don't want to miss out on those returns. Now, when you look after the market peak, in most instances, you could have been 3 months late or 6 months late, and you still would have ended up with positive returns. In some cases, actually, you could have been 12 months late spotting the peak. So I'm not trying to say that you don't want to try and time the market and sell when the market is high. What I'm saying is it's quite often okay. You don't have these sharp peaks necessarily. You might get something of a pattern. Markets might stabilize. You might be able to look back and notice. So an analogy that I was thinking of this weekend, I was reading about Usain Bolt. And I don't know if you knew that he retired last year. He retired in August of last year. And he retired at the World Championships in the summer. And he didn't win. He didn't even come second. He came third. So would you consider that from his perspective, is something of an anticlimax, that he came third and he retired and he didn't go out on that high that maybe he was hoping for? Or could you consider that maybe it was a sensible approach to just assessing that he'd sort of reached his peak and now is definitely the time to retire? Now, I'm not sure that I have the right answer to Usain Bolt's retirement plans and whether he got it right or not. But I guess from our perspective, we know that it's notoriously difficult to be able to time the top of the market. But we also know we don't want to miss out on those green bars. We don't want to miss out on that last period of returns in any cycle. And we also think that for a multi-asset fund, we're not just talking solely about equities here for the multi-asset trust, we've got a broader opportunity set. So either way, as you're approaching the end here, we know that we've got more asset classes available to us, and we think that that's going to be of real benefit when it does become time to reposition the portfolio. So I'm a multi-asset portfolio manager. I really do love diversification. I don't run any portfolios that are sort of equity only, that don't have broader opportunities beyond the UK market. We're global. We're running multi-asset portfolios across our business. Diversification most of the time works. You'll read about sometimes you see correlations rise, you don't get the benefits. You'll have seen that correlations across asset classes they've risen over the last end of 2017 and into 2018. The chart that I'm showing here takes the average correlations across different asset classes. So it might be government bonds to global equities. We're looking US to global equities, US to small cap, emerging markets, high yield bonds, and so on. And we're taking the average correlations across all of these pairs. And you can see that spike up at the end. So certainly correlations have risen, but they've only gone back to average, which is very comforting as a multi-asset investor. So we know that diversification is still working within portfolios, and that really helps us reduce risk without giving up too much in the way of return. So in other words, we hope that we'll be able to get better risk-adjusted returns than does a simple pure equity portfolio there. We hope it'll help us smooth the ride of the net asset value movements. So I haven't really spoken about income so far, but you'll have seen at the beginning that we're looking for 6% total returns through time with around 4% delivered from income. So I know as retirees, you're probably interested in having some income coming into your pocket. You want a predictable yield, but also as a portfolio manager, if we can pick the right assets, then certainly the income that we can get from those assets helps provide a base to our overall total returns, which is very beneficial. If If you look at that blue bar chart down at the bottom, we know that we can get attractive yields from the UK equity market, 3.9%, towards the right-hand side there. We know that UK inflation, the average period here, we've got 2.8%. That's the dotted line you can see. So when we build a portfolio where we're looking to generate an income, we want to do that again in a diversified way. We think getting diversified sources of income is going to be beneficial. You can see over on the right-hand side, we've got some high yielders, 6% from high-yield bonds, 6% from emerging market debt. These are riskier asset classes. You wouldn't want to put all of your investments into some of these asset classes. But we think that getting a mix, blending those together, should enable us to be able to deliver an attractive yield. Just a few words in terms of our overall investment process. So right at the top of this chart here, you can see we've got client goals and objectives. So when we're building any portfolio, we want to really think about the expected return through time, the expected risk through time. So the first step, number one, is we want to figure out what's the best mix of asset classes that if we put together will help us get, not all of the way there usually, but most of the way there. And that's where we build our strategic framework, think about the right mix of equity, the right mix of bonds. Once we've established that, we want to understand, is there something more we can get? Can we get a little bit of alpha from those underlying building blocks? This is where we're working with our colleagues across the organisation. We've got around 500 strategies in JPMorgan. There's plenty to choose from. I work with my colleagues who do manager research, and they help me understand the best utility of some of these strategies in a portfolio. So hopefully we can either get a little bit of alpha. In this case, for MATE, we're looking for extra yield from our global equity sleeve. Now, we are asset allocators. We want to be able to reflect our overall active asset allocation view. You can see on the left of this chart, in that purple box, we have a great research team. We've got 19 individuals who are really helping us formulate our views in terms of where we think different asset classes ought to be positioned. Do we want to be overweight equities, underweight government bonds, and so on? So we've got a great team of people helping us do that. And then finally, we're doing all of this within a very robust risk framework. You have to take risk to generate return, but we want to understand, are we taking an appropriate level of risk, and have we spread it across our investments? So here I am with my co-manager Gareth, looking a little younger, I might add. So we're responsible for all the elements that you can see underneath us, and they're ones I've just described in our investment process. So the active asset allocation, the portfolio construction, manager selection, risk management. And then in terms of the underlying investments, we've got direct equities. We've got a global equity sleeve where we're targeting 4.3% yield from it. We're investing directly in government bonds. We're also using pooled funds, and that's how we allocate to high-yield emerging market debt. You'll see in a moment. We also invest in futures. We want to be able to reflect our active asset allocation view quite cheaply. Futures are a very good way to be able to do that. And then finally, we also want to be able to access some alternative asset classes like infrastructure. So at the moment we own 3i Infrastructure, but we're also looking to invest in one of our internal JPMorgan infrastructure strategies. I probably don't need to tell you guys about why an investment trust. We've got a couple of bullet points here. For a start, that closed-end structure really allows us to be able to access less liquid markets, less liquid investments. And the infrastructure example, I think, is the best example of that. We could also gear, should we feel the need to do so. That's an advantage through time. Be able to help add a little bit extra to returns through time. And then in terms of providing a steady yield, we can smooth through time. So we can use the reserves within the investment trust and also pay out of the capital gains to help smooth that through time. So that's not going to be a structural thing we'll do in MATE, but it will help us smooth that dividend as time goes on. So just in terms of our positioning at the minute, so hopefully you've figured out that even though we're in late cycle, we're still pretty positive in terms of the opportunities for equity market returns. And you can see the positioning in the portfolio at the moment. We're sort of 69% in terms of our equity exposure at the moment. This positive view on equities, I think you can also extend to some of the extended fixed income asset classes. So whether that's emerging market debt, whether that's high yield, you're getting both an attractive yield from these asset classes, and also absent a recession, they're still pretty good for keeping that coupon coming into a portfolio. So we're relatively positively positioned. We're also nicely spread. And you can see by the shape of that pie there, we've got a lot of diversification across different regions. The only other point to mention on this is I commented that when we think about the right mix of asset classes, we come up with our neutral, our strategic asset allocation. So our actual allocation through time, we would anticipate would be around 60% to equities, and so we're about 69% at the moment. So just to sum up here, we're looking for these 6% returns through time, not in any given year, but through time on average. And we're looking to pay an initial dividend of 4%, which will be paid quarterly. Volatility, we're a multi-asset trust. It'll be less than equity markets. We think around 2/3 through time. And we're very well diversified. The only other thing I wanted to mention is we're trading on a 7% discount to our net asset value at the moment. So we're also trading quite cheaply. So I think that is something that's worth noting as you leave the hall today. So I'm going to finish there. Thank you very much. Hannah and I will be at the stand later to answer any questions you might have.